Today, we're going to pull back the curtain on something that affects pretty much all of us, but that very few people truly understand. We're talking about the hidden world of your money. So, you might have a 401k. Maybe you donate to a cause you're passionate about. But what happens after that? I mean, where does the money really go? What kind of choices are being made with it behind the scenes? Well, it turns out the answers reveal this kind of hidden trade-off that governs money at every level. Okay, let's dive right in. We're going to start with the world of personal investing. Because, lurking inside your retirement accounts and investment portfolios is this whole complex system of costs you might not even know you're paying. Pretty much every mutual fund out there has operating costs. And how do they pay for them? Well, they're passed on to you, the investor. These fees get taken directly out of your investment, quietly chipping away at your returns year after year after year. These fees usually come in a couple of different flavors. A front-end load is a fee you pay just for the privilege of buying in. Think of it like a cover charge for your investment. Then you've got a back-end load, which gets you when you try to leave, taking a cut when you sell. Either way, it's a commission that eats into your hard-earned money. So how much are we talking about here? Well, the data shows a pretty stark difference. On average, active funds where a manager is actively picking stocks charge more than double what passive funds do, which just track an index. Now, a 1% difference might not sound like much, right? But over 30 or 40 years of saving, that can add up to tens, even hundreds of thousands of dollars in lost returns. It's a huge deal. Okay, so we've established that fees matter. A lot. But here's why they matter more right now than ever before. Let's move on and see how the whole game of investment returns has changed. Since 2020, the average dividend yield of the S&P 500, that's the slice of profit the biggest companies pay out to their shareholders, has dropped to below 2%. That is a historically tiny slice of the pie. And this isn't just some blip, it's a massive shift. For almost a century, a 3% yield was basically the floor. Even in the 70s and 80s, the average was over 4%. But since the early 90s, well, we've been living in a completely new world. And when your returns are already this low, that 1% fee we were just talking about, it suddenly eats up half of your dividend income. So what happened? Two really big things. First, starting in the late 80s, every time the economy wobbled, central banks flooded the market with cheap money. This sent stock prices soaring, but company profits and the dividends they pay just couldn't keep up. Second, the tech boom. All the big tech companies that dominate the S&P 500 today, they're all about growth. They reinvest their profits instead of handing them out to shareholders. Now, let's pivot for a second, because this tension, this battle between a short-term action and long-term growth, it isn't just happening in your 401k. It is at the absolute heart of a huge, high-stakes debate in the world of big-time philanthropy. On one side, you've got perpetuity. This is the classic model. You build a massive endowment, you invest it, and you use the returns to give away money forever. But on the other side, there's the limited life or spend-down model. The whole argument here is that the world has urgent problems that need solving right now, so why not spend all the money to have the biggest possible impact today? This quote from the Ivy Foundation just perfectly captures that spend-down mindset. They see this closing window of opportunity to tackle climate change and basically decided that waiting around just wasn't an option. The time for impact, they're saying, is now. And here you have the complete counterpoint from Alfred Nobel himself. He set up his fund to last forever, making sure that future generations could keep recognizing and rewarding human achievement long, long after he was gone. It's a really powerful argument for taking the long view. And, this isn't just some theoretical debate in a classroom. This is playing out with billions of real dollars on the line. Let's look at a fascinating real-world example from the effective altruism community. Just look at this chart of funding priorities within that movement. See that huge blue slice? That's long-termism, causes focused on protecting humanity's far-out future, like from the risks of AI. It got over $274 million. That's more than 4 times the money that went to global health and development, which deals with suffering that's happening right this second. But not everyone in that community is on board. This quote from a former major donor asks a really crucial question. The movement is having a massive influence on where money and talent are going, especially toward these long-termist ideas. But is it having a real positive impact, or is it just pulling resources away from problems we actually know we can solve today? So, we've seen how hidden fees can chip away at your long term investments and how philanthropists are wrestling with whether to spend now or invest for the future. So, what's the common thread here? It all boils down to this one powerful trade off. Do you take a slightly smaller return now by paying higher fees for potentially bigger gains way down the road? Do you spend $1 billion today to solve an urgent crisis? Or do you invest it to create a permanent stream of funding for generations to come? There's just no easy answer. So here's the crucial point: the exact same fundamental questions about time, impact, and growth. They govern both the tiny little fees in your retirement account and the billion-dollar decisions of major foundations. Understanding this trade-off is really the first step to making smarter choices with your own money. Which brings us to the final question: what do you value more?